Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And in order for me to show you just how incredible technical analysis is when used as a forecasting tool, I leave my lines on the chart each and every week so you can see the evidence of how this all plays out. Now, this diagonal line right here was drawn last Friday, again, before any of this price action even took place. And I mentioned last week the old saying of sell in May and go away, and therefore I drew my line in this downward direction saying that we would most likely see lower prices, especially towards the end of the week, with the end of that line right there being my target price. Now, interestingly enough, Tuesday we hit the target price right off the bat when the markets opened lower and even gapped lower. On Wednesday, the market moved back up to fill that slight gap, and then on Thursday we dropped back down again to hang right around that target price of around 244.15. So that's what happened. That's how it played out. And you might be asking, well, okay, well, that's great. Shows some accuracy, but what does that mean for next week? Well, there's some signs that are showing up here that are really conflicting among the markets. And first of which is we rallied just a little bit today, Friday, as I record this on June 1st. And we stopped right at that blue line, which is the 20-period moving average. Historically, the 20-period moving average will act as support and resistance depending on where the stock is, so it kind of flips back and forth in role reversal fashion. But the spinning top is usually a sign of indecision, and the fact that we're seeing this on lower volume tells me that the buyers really did not come back with any kind of force to rally the market back up. So that is more bearish than bullish. So what I'm going to do is draw my line just like that for next week, because we're having a full trading week next week. All 5 days we'll have trading activity, and I think that the diamonds will most likely pull back. Now, with that said, let's take a look at the spiders, which is the S&P 500 ETF, ticker symbol SPY. And you can see, again, I drew my line in a downward direction. Tuesday, we immediately filled my gap. Interestingly enough here, though, is that when I drew this line, this was a role reversal support level that I drew, saying that we would most likely test that support. And look at that. Pretty amazing, isn't it? We came to the penny right there of support, and then we bounced up. So we hit the target, bounced up, and look where we wound up, right at a resistance point right here. Again, that's what I drew last week on lower volume. So like the diamonds, I'm going to draw this line in a downward direction. I don't think we're going to see a major sell-off, but I do think we're going to see more selling activity than buying activity, so the price will most likely drift lower. Now, with the S&P being analyzed like that, let me take a look at the volatility index. I'm flipping to a contrarian indicator that we use pretty much as a leading indicator. And you can see here as I zoom in, my lines from last week are still in place. I said we would most likely rally on the VIX. We stormed up on Tuesday and even tested the high from back here. But this big red candle is telling us that the markets were bullish on Friday. We did rally for the most part, but there is support right here for the VIX. So I think we're going to see next week is we'll see a slight drop in the VIX, and then ultimately we'll see the VIX moving back up to this general area right around 16.5. Now remember, if the VIX starts to rally, that's bearish for the S&P and will most likely trigger the domino effect in the rest of the market. So the VIX is the leading indicator. Again, we'll see a slight drop early in the week, but ultimately we'll see the VIX rally, which is bearish for the general markets. Now, let's hop to a more broad-based index, which is the Russell 2000. On Tuesday, we pulled back roughly half of what I said we would, and we did not test the support level, but I do believe, I'm just going to move this over, I do believe the Russell 2000 is going to pull back, probably to the 20-period moving average. There's a rubber band effect taking place right now. If you've followed along with the market guys, you know what that is. But if you haven't followed along with the market guys, what that means is when we see a price divergence above or below that 20-period moving average, imagine one end of the rubber band being connected to the moving average, the other end connected to price. As the rubber band gets stretched, it'll have a tendency to be brought back to that moving average. Hence the reason why I think the Russell 2000 will pull back the next week. Finally, the Qs. Now, out of all the markets, the Qs showed the most strength, and here's what I'm talking about. We pulled back just a little bit early in the week. We did not pull back all the way to my target, but instead what we did is we rallied above resistance. Now, this is, again, why I said at the very beginning we're having conflicting signals, because we broke out over resistance in the Qs, and we did so on stronger volume. So what I think we could see for next week is a test of this resistance level up here. So I think the Qs will go up before coming lower, test that resistance, and then pull back. So what we could see, and this is good news for the traders, we could see the NASDAQ market being stuck in a trading channel. Let me clean this up a little bit so we can remove some of the distractions right here. I think that trading channel might stay in place for a good while, giving us an opportunity to get in and out of the NASDAQ stocks. And if you're an option trader, again, this means money in the bank. There's lots of things we can do on the option side, many different types of strategies that we can incorporate to make money. And that's what we do here at the Market Guys. We teach people how to make money. By the way, if you're interested in going to the Traders Expo, the CME is hosting that. I'll be one of the guest speakers. I'll be talking about how to manage risk in volatile markets with a highlight of the cryptocurrency market. There's going to be a lot of interest in cryptocurrencies there at the Traders Expo, and I'm going to be talking about how to manage risk. I would suggest that you book your flights early if you're coming in from outside Chicago in any way, so you could save a seat. There's going to be thousands of people coming to this, and there's lots of speakers that will be speaking alongside of me and sharing that stage. So they'll most likely have it set up as in a workshop format where you pick your topics, reserve your seats in those particular sessions, and then we're going to have an action-packed hour, almost an hour of activity there at the CME. So I'm looking forward to that. Stay tuned to the Market Guys, and each and every week I'll put out these weekly market reports so you can see how, again, technical analysis works as a tool for forecasting the markets. I think you'll be surprised. So have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.